This is the IUX Education Podcast, your shortcut to smarter trading and investing.
Where complex markets become simple. Let's dive in.
Welcome to the Deep Dive. We're here to plunge into these compelling stories and pull out the wisdom, well, the stuff you can actually use. Today, we're tackling a real legend in the finance world, Bill Lipschutz. You might know him as the Sultan of Currencies.
That name alone, Sultan of Currencies, it just screams massive success, right?
It really does. But looking through the sources, his journey is way more than just big wins. It's complex, it's human. And what really grabbed me wasn't just, the trading genius. It's that his whole philosophy, his whole approach, it seems rooted in understanding emotion, human emotion, and crucially mastering himself. So we're going to trace that path from a really surprising start, actually, to becoming this absolute titan in foreign exchange. We want to pull out those key lessons that honestly apply way beyond just trading floors.
Absolutely. And we've gone through quite a bit for this: articles, interviews, some historical accounts. They give you a really unique window into his thinking, those make or break moments. So the mission for you listening is, let's extract that practical stuff, the insights on resilience, on psychology, risk management. These are things you can use anywhere. Personal projects, career moves, just managing your focus day to day.
Okay, let's dive in. When I first heard Sultan of Currencies, I pictured someone, maybe groomed for Wall Street from day one.
Yeah, like a finance prodigy.
Exactly. But Bill Lipschutz, that wasn't him at all, was it? What did the sources say about where he actually started? It's pretty unexpected.
It really is quite remarkable. You have to go back to the late 1970s. He's at Cornell University. But he's not studying economics or finance.
Yeah.
Not at all. He was deep into architectural design.
Architecture, wow.
Yeah, it just highlights how unconventional his route into high finance was. He definitely wasn't following the standard script.
So, an architect in the making. How does he even get into trading then? It wasn't like he snagged some fancy internship, right? It was more personal.
Much more personal. It started with an inheritance from his grandmother.
Yeah.
$12,000.
Okay, 12 grand. Not nothing, but not a Wall Street fortune either.
Exactly. For a lot of people, that might go into savings, maybe a safe, boring investment. But Lipschutz, he saw it differently. That became his seed capital. He started actively trading with it.
And this is where the story just takes off, doesn't it? He didn't just grow it slowly. Our sources say he turned that $12,000 into, $250,000 while still in college?
$250,000, yeah.
I mean, think about that. You're a student studying architecture, and suddenly you've made $250,000 from $12,000. That must have felt incredible, intoxicating even. How did he handle that, according to the sources, that kind of sudden success?
Well, that's the thing. It was testament to, some raw talent, maybe some beginner's luck too. But it also seems to have bred this really dangerous sense of invincibility.
Ah, the Midas touch feeling.
Exactly. It's a classic trap in trading, right?
Yeah.
You have a few big wins early on,
Yeah.
and you start thinking you've cracked the code,
Yeah.
that you're smarter than the market. The sources really point to this period as one of growing overconfidence. And that, unfortunately, set the stage for a really, really hard lesson.
Okay, so he's riding high, $250,000 in the bank, feeling unstoppable. What happens next? Does this amazing run just keep going, or is there a twist?
Oh, there's a twist, all right, a huge one. That entire $250,000.
Yeah.
He lost it, all of it, every single cent, gone in one single trade.
No way, the whole $250,000.
Wiped out.
Yeah.
Completely. Imagine how devastating that must have felt, especially after watching it grow so fast from that initial small sum. It wasn't a slow bleed. It was just catastrophic failure.
That is absolutely soul-crushing to even think about. How does something like that even happen? Was it just terrible luck, a freak market event, or was it something in his approach?
The sources are really clear on this, and he acknowledged it himself later. It wasn't just bad luck. It was that lethal mix, sheer overconfidence, thinking he couldn't lose.
Right.
And, crucially, a fundamental lack of risk management. He just didn't have the proper controls in place. He likely took on way, way too much risk in that one position because he felt so sure he was right. But here's the fascinating part. This absolute disaster, this total wipeout, it became his greatest teacher.
Okay. How so?
It forced him to realize something profound. He understood that trading wasn't just about analysis. It wasn't just crunching numbers or reading charts or predicting where things would go. It was fundamentally about managing yourself. He actually said, and this quote appears a lot, most people think trading is about analysis, but that's only the beginning. Managing yourself. So it's less about the market, more about the person trading it. Exactly. That was the core insight. Why was it so game-changing? Because he learned markets aren't always logical. Far from it, actually. They are driven primarily by human emotions. Fear, greed, hope. These powerful forces are what really move prices, often completely detached from the underlying data or fundamentals.
So he saw how, like, a panic could cascade.
Precisely. Or how irrational exuberance could push things way too high. He realized that understanding that emotional landscape, the psychology of the crowd, was just as important, maybe more important than just the technicals. He stopped trying to be a perfect predictor.
And started trying to be prepared.
Prepared. That's a great way to put it. This loss didn't just make him more cautious, it completely reshaped his strategy. He started blending the technical analysis with his deep understanding of market psychology, and critically, he brought in strict rules about position sizing, how much he would risk on any given idea.
So the focus shifted. It wasn't about always being right anymore.
No. It became about survival, about being prepared for when you were wrong so it wouldn't take you out of the game. That became his superpower, that preparedness.
Right, because after that massive loss at Cornell, he didn't just pack it in and go back to architecture, did he?
Not at all. Quite the opposite, actually. He graduated, and he went straight into the belly of the beast. He joined Salomon Brothers.
Salomon Brothers, that was a huge, aggressive player back then.
Absolutely. And his comeback there was, well, legendary. It wasn't slow. Within just a few years, armed with these hard-won lessons, he rose to become the head of their global foreign exchange division, the FX desk.
Head of global FX at Salomon. After blowing up completely just a few years earlier, that's incredible.
It really is. And he wasn't just holding the position, he was crushing it, generating hundreds of millions of dollars in profit for the firm.
Wow.
It just shows how powerful learning from failure can be, right? If you truly internalize the lessons and build a disciplined system around them. He wasn't just avoiding mistakes, he built a fortress of principles.
Okay, so what were those core principles? Our sources identified, 3 big reasons for that incredible success at Salomon.
Yeah, 3 key pillars really stand out. First one, risk discipline. Absolute non-negotiable discipline. He knew exactly how much he stood to lose on any trade before he put it on. No ambiguity, no hoping. He had his exit point defined.
Okay, risk discipline. Makes sense. What's number 2?
Number 2, emotional control. This was massive for him, obviously, given his history. He learned never to let a big win make him cocky or overconfident. He knew where that led.
Right back to the $250K loss.
Exactly. And just as importantly, he didn't let losses derail him emotionally. No revenge trading, no impulsive decisions trying to win it back immediately. He talked about literally stepping away from the screens after a bad trade, taking a walk, resetting, staying level-headed, focus on the process, not the last P&L number.
Discipline and emotional stability. Got it. And the third?
The third was never-ending learning, constant adaptation. Markets change, global economics shift, currencies react to new forces. He knew he couldn't stand still. So he was always reading, talking to people, analyzing, trying to understand the evolving landscape. It was an active, ongoing process, not just something he did once.
And underpinning all of that, especially the risk discipline, was that famous rule he had, the position sizing rule.
Ah, yes, the 1% to 3% rule. Foundational.
Tell us about that. He never risked more than 1% to 3% of his total capital on any single trade idea. That sounds almost too simple, but it was crucial, wasn't it?
It sounds simple, but it's incredibly powerful. Think about it. If you only risk, say, 2% on any one trade, how many trades do you have to lose in a row before you seriously damage your capital?
Wow, yeah, a lot. Like 20, 30, even more before you're really hurting.
Precisely. It guarantees survival. It ensures you stay in the game. Even the best traders have losing streaks. This rule meant those streaks wouldn't knock him out. His core philosophy boiled down to something like, if trading is your passion, your mission is to never blow up. He learned that the hard way.
Never blow up, stay in the game.
Longevity beats short-term home runs every single time. It allowed him to absorb losses, learn, and wait for the next good opportunity, knowing he'd still have the capital to act on it.
Okay, this is all fascinating in the context of trading, but let's bring it home. What does this story, these principles mean for you listening right now? Most of us aren't managing FX desks at major banks. How do these lessons apply to, say, launching a side project, making a career change, or just handling the ups and downs of everyday life?
That's the really valuable part, I think, because these principles are incredibly universal. We've kind of distilled 4 big takeaways from Lipschutz's journey that apply almost anywhere. Okay, takeaway number 1, don't go all in. That 1-3% rule. Apply it metaphorically, meaning don't bet your entire future. your entire savings, or all your energy on one single thing. Whether it's a new business idea, a job opportunity, even a relationship investment. Don't quit your day job for a risky venture without a safety net. Don't pour every last penny into one speculative investment. Size your bets in life wisely. Diversify your efforts. Always have a fallback, a plan B.
Spread the risk. Got it. What's number 2?
Number 2, don't chase losses. This is huge. When something isn't working out, a project is failing, a decision looks wrong. The instinct can be to just throw more resources at it, more time, more money, more emotional energy, just trying to force it to work or recoup what you've already sunk in.
The sunk cost fallacy.
Exactly. Lipschutz learned to cut losses quickly in trading. The life lesson is similar. Step back. Take an honest look. Why isn't it working? Learn from it. Sometimes the smartest move is to accept the loss, learn the lesson, and redirect your energy elsewhere, rather than blindly doubling down on something that's clearly failing.
Okay, don't go all in, don't chase losses. What's third?
Third, understand the crowd. Remember how Lipschutz realized markets are driven by emotion, fear, and greed?
Yeah.
Well, so many parts of life are emotional ecosystems too. Think about your workplace, office politics, social media trends, even just the mood of your family or friends. Understanding those group dynamics, the underlying emotions driving behavior, is often way more insightful than just looking at the surface facts or data. Can you spot when collective enthusiasm is maybe getting irrational? Or when widespread fear is creating an overreaction? Maybe even an opportunity. That emotional intelligence is key.
Reading the room, essentially, but on a larger scale. Makes sense. And the last one, number 4.
Number 4, accept risk. This might sound counterintuitive after talking about risk management, but it's crucial. Growth, success, achieving anything meaningful, it always involves some element of risk. You can't eliminate it entirely without stagnating.
So the goal isn't zero risk?
No. The goal is to manage risk intelligently. Understand it. Quantify it if you can. Mitigate the downsides. But accept that stepping outside your comfort zone, trying new things, it inherently involves uncertainty and the possibility of failure. Take calculated risks, not reckless ones. Be prepared for bumps, but don't let the fear of them paralyze you.
Wow. Those are powerful. Don't go all in, don't chase losses, understand the crowd, and accept managed risk. And it all comes back to resilience, doesn't it? Lipschutz had that spectacular blow-up, lost everything, could have easily given up. But he didn't. He used that absolute catastrophe as the raw material to forge an unshakable mindset. He turned failure into the foundation for legendary success. It's an incredible testament to turning setbacks into strengths. So the core message from Bill Lipschutz's journey, it seems, isn't about avoiding failure. You probably can't, not entirely. It's about your response to failure, how you learn from it, how you use it to build that resilience, that discipline, that self-awareness that serves you over the long run.
Couldn't agree more. Winning, whether it's in trading or just in navigating life, really does seem to come down to discipline, preparation, and resilience. And those qualities, more often than not, are forged in the fire of setbacks. It's not about the punches you dodge, maybe, but about learning how to take a hit, get back up, and be stronger for it.
So something for all of you to think about this week. How can you apply these lessons? That self-management, that risk discipline, that emotional control. Where in your life, your finances, your career, your personal goals could these principles make a real difference? The journey, as they say, is ongoing. We'll catch you on the next deep dive.
And this is the IUX Education Podcast, where trading confidence begins.
That's a wrap for today. This episode was brought to you by IUX Trading Platform, your trusted partner for smarter investing.